Hi class. I'm glad to be with you again. One thing I learned from the Chapter 2 problems that I posted is that I was talking way too slow. I need to move on a little more quickly, and that's fine with me. I think I was just not being able to see people's faces while I was doing this. I was over-exaggerating and pausing too much and reinforcing too many things, but we'll move along a little more quickly this time. Okay, at this time I would like to demonstrate some problems out of Chapter 3. I'm looking at, as we know, adjustments are difficult, and we have to be able to think about what it really means to match expenses with revenues. So I'm going to start with SE2. SE2 says the prepaid insurance account began the year with a balance of $460. Okay, I'm going to just see what that looks like. Prepaid insurance has a balance of $460 as a beginning balance. Okay. During the year, insurance in the amount of $1,040 was purchased. Okay, that means the account would have been debited as we purchased the prepaid insurance. At the end of the year, the amount of insurance still unexpired was $700. Okay, so what you have to watch for in these problems is what piece of information are they giving me? Are they telling me how much is expired, or are they telling me what is still left unexpired? They're telling us that $700 is still unexpired at the end of the year, and that should be our ending balance. So we need to solve for how much prepaid insurance needs to be taken out of prepaid and moved to insurance expense, because it's not prepaid anymore. The time has clicked by, and we've actually, the insurance has actually expired. Like maybe we bought a policy that lasted for 2 years, and 6 months of that has gone by, whatever the case may be. So what we want to do is we want to move an amount of insurance out of prepaid insurance and into insurance expense so that the prepaid account shows $700 at the end of the period. Well, $460 plus $1040 would be $1,600. So what amount from $1,600 would get us back to $700? It'd be $900. Okay, so we're going to debit insurance expense for $900 and credit prepaid insurance for $900. Okay? So you have adjusted prepaid insurance to actual. All right, let's move on. Let's look at SE3. The supplies account began the year with a balance of $380. Okay, let me make my T account here. Supplies, as in our supplies inventory closet. Think of it that way, a supplies inventory closet. We started out with a balance of $380 as a beginning balance. During the year, supplies in the amount of $980 were purchased. Okay? Get some check figures real quick. Just because I'm doing this on the fly, I don't want to scribble up the paper with a bunch of additions and subtractions. Then the problem tells us that at the end of the year, the inventory supplies on hand was $440. Okay, so what this means is that we bought supplies all year long and we just kept putting them into the supplies account. And then maybe you're the accounting manager and you told your little assistant, Joe Blow, to go into the supplies closet and see how much we had of everything, and then look those invoices up and cost it out and see how much stuff is actually in the supplies closet at the end of the year. So you started out with $380, you bought $980 through the year, you've got $440 left at the end of the year. What amount needs to be taken out of supplies and put into supplies expense? Okay? Well, 380 plus 980 minus something equals 440, and that amount would be, I believe, 920. 380 plus 980 minus 920 would be 440. Okay? So we need to expense the $920 worth of expenses, or worth of supplies that have actually been used during this period. Okay, very good. All right, moving on to SE4. Now later in the semester we will do an entire chapter on fixed assets and depreciation, expense, etc. But for this adjustment, we just have to accept the information they give us, even though we don't understand very much about it yet. They're telling us that the depreciation expense on office equipment for the month of March is $100. Now, you might remember from your reading that when we buy a fixed asset, we have to decide, do we think we're going to keep it for 5 years? Do we think we're going to keep it for 6 years? Do we think we're going to keep it for 10 years? We do our best to figure out how long it's going to last, and then we write it off across time and move that cost into operations. Okay, so they're telling us that the depreciation expense is $100 for the month of March, and we need to just accept that. Okay? And then, okay, so we need to make a journal entry for depreciation. It says, prepare the adjusting entry to record depreciation for March and show the balance sheet presentation for office equipment and related accounts after the March 31 adjustment. So the March 31 adjustment is very simple. We're going to record 1 month of depreciation expense. And we are going to credit the accumulated depreciation account, office equipment. Don't forget that the accumulated depreciation account sits up with the assets, but it has a credit balance, and so it's a contra account to assets. Then the problem says, what would the balance sheet presentation, assuming that you had paid $1,900 for the equipment, what would it look like at March 31st if we've already taken 3 months of depreciation? Okay, well, under the assets section of the balance sheet, you would have office equipment, $1,900, and you would have accumulated depreciation of 3 months. 3 times 100. So you would have office equipment as an asset, accumulated depreciation as a contra account to the asset, and net assets would show as $1,400. That's what the balance sheet would look like if you had had this office equipment for 3 months. Okay? All right, let's move on to SE5. Having a lot of trouble lining this up perfectly. Oh, I see why I've got another piece of paper under there. All right, do it this way. SE5. All right, wages are paid each Saturday for a 6-day work week. Wages are currently $13.80 per week. Prepare the adjusting entry required on June 30, assuming July 1 falls on a Tuesday. Okay, here's what happens. If you've got a job where you work, you get paid every week or every 2 weeks, your pay date is going to fall in the middle. The end of the month is going to end up falling in the middle of a pay period some way. So we're going to have people that have earned wages from us, but we're not going to pay them until the next month. Okay, so this is what's happening here. Let's see, we've got Sunday, Monday, Tuesday, Wednesday, Thursday, Friday, Saturday. Okay, there's the whole week. The problem tells us that we will pay out $13.80 on Saturday for a 6-day work week. So apparently we're dead on Sunday, okay? So here's a 6-day work week, and we'll pay and $13.80 will be paid out on Saturday. Then the problem says that July 1st is Tuesday. So if July 1st is Tuesday, that means June 30th is on Monday. And June 30th is the end of our month that we're trying to do financial statements for. Okay? So here's the best we can do. We don't know exactly the hours that people worked. So the best we can do is to divide $13.80 out over 6 days. Okay? And then accrue the June day, that the wages that actually were earned in June but won't be paid till later. We need to make an adjusting entry to accrue those wages. See, we're trying to do matching. We're trying to match all the revenues in one period that happened, all the expenses that happened in the same period as the revenues. All right, so $13.80 divided by 6 would be how much? $230. Okay, so $230 belongs in June. So we need to make an adjusting entry, okay, that debits wages expense for $230 and credits wages payable. Notice that we normally make a separate account for wages payable. Okay? All right, let's look at SE6. Okay, SE6. During the month of August, deposits in the amount of $1,100 were received for services to be performed. By the end of the month, services in the amount of $760 had been performed. Prepare the necessary adjustment for service revenue at the end of the month. Okay, so here's the deal. They gave you a different piece of information this time. They told you how much work they did. They didn't tell you how much work was left to be done, like they do in prepaid insurance, like they did in SE2. All right? So what's happening over here is we've got unearned revenue account, which, as you know, is a liability, because when people pay us before we do the work for them, we either owe them the work or we owe them the money back. All right, so it said that we got deposits of $1,100. So when people paid us early, we would have debited cash and we would have credited unearned revenue. Then they tell us that by the end of the month, services in the amount of $760 had been performed. Okay, so we need to get $760 out of unearned revenue and into revenue. Okay, so we're going to debit unearned revenue for $760. See, I'm debiting this liability account to reduce it. Okay, and I'm going to credit revenue. Quite simply, that's what we're doing. Okay, that's the journal entry for that. Okay, that's the end of problems SE2 through 6, and I will move on to some other problems in a little bit. Thank you.